Long-legged doji is one of the reversal candlestick patterns that is more important at the end of an uptrend. As mentioned earlier, this pattern has long upper and lower shadows and almost no real body and shows the indecision in the market. In fact, a long-legged doji is very similar to a spinning top or the high wave. The only difference is the size of its real body. This pattern will be of most significance if it is formed after a gap in the direction of a trend. The top and bottom shadows are ideally the same sizes, but this is not always the case. To verify this pattern, like the rest of the single candlestick patterns, we must pay close attention to the formation of candles after the long-legged doji. If a candle closes below the doji's closing price or more conservatively below the low of the doji, you can enter into a sell position. The formation of these patterns in an area of support or resistance, such as pivot points, or when they contact the upper or lower lines of channels or trend lines, increases their strength and importance. In this video, you can see that we are in a downtrend, and after a while a corrective phase starts. Then the price begins to form several long-legged doji patterns around $26.5, which is also a strong resistance level. As mentioned before, candlestick patterns can be formed anywhere in the market, but we only care about those that are formed in important areas of support or resistance and are also in line with market dominant trend. Given these issues, it is very likely that the market will reverse from here. In this case, we can go short by placing a sell order under the valid fractal and put our stop loss above the resistance area. Exit points can be defined according to different methods, but if we want to act solely on price action, the two market levels around $23.5 and $22 can be reliable exit points, and as you can see, the price has touched both of these targets and even gone far beyond that. Dragonfly is one of the reversal candlestick patterns that, if appears at the end of a downtrend, can be a sign of a bullish reversal. The existence of long lower shadow and the absence of upper shadow indicates high buying pressure. Nevertheless, in some cases, this pattern may be formed at the end of an uptrend, in which case it can be a sign of a bearish reversal, but more confirmations are needed. I would like to emphasize once again that all candlestick patterns can have both reversal and continuation rules, depends on where they are formed on the chart. And the dragonfly pattern is no exception. Here you see that we are in an uptrend, and after a sharp drop in price, a dragonfly pattern has been formed with a long lower shadow that warrants a possible trend reversal. But as we have said before, in order for candlestick patterns to be most effective, they must appear on important areas of support or resistance, otherwise they may not work well. Also, the price movement after these patterns should be carefully monitored. By changing the scale of the chart, we try to draw a long-term trend line. And as you can see, the price has reacted to this line several times and has maintained its upward trend. And now the dragonfly pattern is formed on this trend line. To get more confirmation, we can also use the Fibonacci retracement levels. And as you can see, in a narrow area that is called PRZ or price reversal zone, the two Fibonacci levels 0.382 and 0.5 drawn from two market lows are close to each other. They are also located near the trend line, which can multiply the reversal power of this pattern. As can be noted, the stochastic indicator is in an oversold area, with the red and blue lines intersecting upwards and exiting that area, so the final signal is issued. Of course, more confirmations such as the formation of a 1, 2, 3 pattern or several bullish divergences can be used to validate as much as possible, but because it was thought to confuse you, they have been omitted in this example. Finally, after receiving all this confirmation, we can enter into a buy position at the top of the dragonfly and put our stop loss below the low of the pattern, and use that obvious resistance for your take profit level based on price action. Another method that can be used is to add a line parallel to the trend line we drew earlier, and therefore by creating a channel, we can get out of the trade when the price touches the upper line of this channel. In the following, as you can see, the price has touched both of these levels. Gravestone Doji is one of the reversal candlestick patterns that, if appears at the end of an uptrend, can be a sign of a bearish reversal. The existence of long upper shadow and the absence of lower shadow indicates high selling pressure. Nevertheless, in some cases this pattern may be formed at the end of a downtrend, in which case it can be a sign of a bullish reversal, but more confirmations are needed. Here you can see that we are in an uptrend, but after a while, with the formation of a spinning top pattern that we talked about in detail in the previous video, the market enters a consolidation phase, which indicates the indecision of traders. Then the price forms a gravestone pattern after creating a gap at the resistance level, which indicates that the price is unable to cross this barrier, and this is the first sign of a possible price reversal. After that, the price opens with a price gap downwards, which is a strong sign of further decline in the market. We can use the MACD to get more confirmation, and as you can see, there is a clear divergence between the price and the indicator. So we are almost certain that if the market breaks this support level, a reversal can happen. And consequently, the market starts a downtrend that lasted for more than 3 years. And the gravestone pattern was in fact a turning point in the market. If you found it handy and learned something new, consider leaving me a like to show your support. Subscribe to my channel and hit the bell icon to be notified when I upload a video. Good luck with your trading.